into a territory where it was not moving at all. I
Hmm.
mean,
Hmm.
it was a very, very dull type of market. No movement was happening in these small cap stocks. So I don't know what will happen in the future, but we should be prepared for that because
Right. Right.
uh, ignoring valuation is can be very dangerous in the long run. Some of these stocks are becoming very very overvalued, looking at various matrices of valuation.
Right. But a lot of the movement I feel in a lot of stocks is driven by fundamentals. It is driven by strong earnings and the fact that the stock was earlier trading at a very cheap valuation. So now a lot of stocks are going through re-rating, and their true value is being discovered. So I'm just curious, why is this happening now and why it did not happen before?
Uh, what is coming in my mind is that market is like a pendulum,
Hmm.
where if some stock is undervalued, uh, it will not become reasonably valued. It will go into the territory of overvalued, and
Hmm.
then again will come back to undervalued. I mean, it's like pendulum. So,
Right.
for example, if we consider 50 PE as undervalued, 15 PE is undervalued, and the same stock will go to 40 and 45 PE. But
Hmm.
the reasonable valuation is somewhere in between. It is neither 15 PE nor 40 PE. It may be around 20 or 25 like that.
Hmm.
So,
Hmm. Hmm.
I mean, if some stock has gone to a valuation of, say, for example, 40 PE, it is not sustainable until unless it is supported by growth in the earnings. And
Hmm.
one of the important thing that normally we ignore is the cyclicality.
Right.
Almost all industries are cyclical, but some industries are more cyclical than the other industries. And at the peak of this cycle, the PE looks artificially low, and we assume that it is undervalued. But in the next 1 year, 2 year, maybe earnings will be depressed, or suddenly the company will start, reporting losses. Then imagine what will happen to the PE, or
Hmm.
suddenly it will start looking very, very overvalued. So cyclicality is one thing, uh, and so very if we look for those businesses which are not very cyclical, it is very difficult to find such businesses. For example, right now, capex cycle is going on in most of the industries. So all stocks which are related with capital expenditure, all engineering stocks, heavy machinery stocks, they are flying like anything. But this will not continue like this forever, because from the past experience, we know that every industry goes through a cycle, and we are going through that cycle in some of the industries like capex related stocks, engineering related stocks, heavy machinery related stocks. They are, businesses are, they have a lot of demand. A lot of businesses are incurring capital expenditure, but we should be prepared for dull period also. Suddenly, maybe after 6 months, 1 year, we don't know, but the cycle has to end. Up cycle has to be followed up by a dull market, a low demand.
Hmm.
So, so we should keep in mind because these stocks, if we look at their valuation for example, PE ratio itself, the PE ratio of such stocks will be looking cheap. For example, 20 PE, Elecom Engineering, or I mean, and
Hmm.
companies like that. The 20 PE is not a very high PE, but what will happen if suddenly the profits are half? If the company reports half of the profit, then suddenly the PE will shoot up to 50 or maybe more than that. So then we will realize that these businesses are cyclical, and assigning a high PE to such businesses was a fallacy, was not reasonable.
So yes, so this is one thing that investors need to realize, that low PE could just be due to cyclically high earnings, and high PE could be because of cyclically low earnings.
Yes,
Uh,
yes,
it's not because the price is low, it's just that the earnings have been high. And on the other
yes,
hand, it's not that the price is high, it's just that the earnings have been low.
yes.
So that from that mathematical lens, people need to gauge valuation.
So I'm not saying that we should not invest in cyclical stocks, but we should be aware of what is happening. I mean, why it is, the valuation, why PE ratio is going up or why it is going down. What is happening to the earnings? So
Hmm.
price is not the only thing that is going into that formula. Earning is also one of the input.
Correct.
Normally, we ignore that. We assume that a business will grow steadily at a constant rate, which is unrealistic expectation from businesses.
Right, right, right.
Even normally we give the example of FMCG stocks that said they are very predictable. Their returns are very predictable. That is why they also command very high PE ratio also. But even FMCG stocks also face some kind of cyclicality.
Right, right. Absolutely. What would be regarding PE? One thing I have noticed, that very high growth companies, very predictable companies in the US, they get pretty low PE compared to Indian companies. So why
Yeah,
this
yeah.
euphoria in
Yes,
Indian market?
yes. That is the euphoria. That is the time when we should start becoming cautious, and we should be very careful because that is one yardstick or standard uh, we should keep in mind. That, say, for example, in India, pipe stocks, cable stocks, they are trading at a PE of more than 50. So for an American investor, it is very difficult to understand why
ये
a
हो क्या रहा
business, yeah, why a business which has a 9% OPM is trading at a PE of more than 50. So in US, such businesses are commodity business, and they don't command a premium valuation.
है?
So
Correct.
India is not different. Although the growth rate in India is much higher than the growth of the economy in US. Uh, the GDP growth rate in India is the highest right now all over the world. So, but even then, 50 plus is a very dangerous territory, which will not sustain.
Correct.
Even
Correct.
if even if it sustains, then we will not get a return of, say, for example, more than 30%, 40% from that point. From if our entry valuation is 50 PE, then
Right. So
we
much
cannot expect
growth
very
is
high rate.
already high. Right.
Yeah. They may remain high, but from that point onwards, upside may be very limited
Right, right, right.
because entry valuation is also important. Uh, so a lot of stocks I was looking at my portfolio. There a lot of stocks that I bought at a PE of less than 20. Right now they are trading at a valuation of more than 50. So some of them I have started, selling. But the point I want to emphasize here is that our entry valuation is also important
Absolutely.
because the return has come, normally the return comes from earnings growth. But if our entry valuation is very good, then the return will come from re-rating also. So our entry, say for example, if the our entry PE was 15, and during the same period, the PE has become 50 or 40. So a lot of return has come from, PE re-rating instead of the earnings growth.
Right. A lot of the times. Yeah.
And one more thing that is coming to my mind, those people, some of them, those who are in touch with me and they want to start the journey of investing, it is very difficult for them to, uh, to digest the fact that investing is a probability game. They
Right,
want,
right,
100%, they want to be 100% sure. They are interested in some stocks that they say that it will double in the next 1 year or in the next 6 months, it will double. They are interested in such kind of stocks. But no matter how much research you have done on a particular stock, on a particular business, nobody can be sure of what will happen to the prices in the next 1 year. So it's always a game of probability. The only thing is that you should be aware of what you are doing, what you are buying, why you are buying, what is your logic, what is your rationale of buying stock, and then what is the reason why you are selling a stock. Uh, is there something has changed with the business? Your hypothesis might have gone wrong, so you may exit from that investment. So this is a continuous process, and this is probability based. You have to take chances, and this conversation is also related with diversification, because as Warren Buffett says that diversification is insurance against ignorance,
right. Mm.
because we cannot be sure that we know everything. Nobody, no matter how much research, every con call, we have read every con call, we have read the comments of every research analyst, we have gone through interviews of the promoter, but even then we cannot be sure, because there is something called the risk of unknown risk.
Yes.
There are risks that we know that this may go wrong, this may go wrong. uh, there are several things that we already know that these are the things that can go wrong with this company, but there are things which even we don't know that may go wrong.
Yeah.
So that is the risk
Actually,
of unknown.
one time you said something very beautiful in this regard. You said that even the management doesn't know ultimately what will happen to the company. I mean,
Yes, yes.
right. Yes, yes, yeah.
And I was having a conversation with someone. Then it was, about a company, Talbros. So
Yeah, yeah.
Talbros, just a few days back, they disclosed a very large order that they have received an order of, say, five more than 500 crore order. It's a
Mm.
small company having a
Yeah,
market
yeah.
cap of 1,000 crore. So an order size of 500 crore is a big order for that company. So So this disclosure was made in the night, and the market opened at 20%. At a 20% upper circuit.
Yeah. Right.
The person said to me that all insiders are making money. They might have bought stocks in advance, and then after buying those stocks, they have disclosed this information to the market.
Hmm.
So this kind of thinking is very naive. I mean, I'm not denying that this might not be happening. Insider trading might not be happening, but today or tomorrow they will be caught. Such promoters or such insiders will be penalized by the SEBI. SEBI is very active, and if insider trading happens in a particular stock very frequently, then it will become known by the market.
Yeah.
So so what I think is that investment is basically critical thinking. We have to keep our eyes, ears open. We have to observe the market, observe the surroundings, observe the news, observe everything, what is happening with the company, what is happening with an industry, what is happening with different sectors of the economy, what is happening with the government regulations, what changes are happening. So even I was recently I have realized the importance of government regulations also. They are very important because whenever any regulatory changes take place, uh, that impacts the profitability of an industry in a very gigantic way. For example, the electronics manufacturing sector in India is currently being promoted at a policy level by the government. Just yesterday, there was a news that MOU has been signed with some European Union body regarding semiconductor manufacturing in India. And this MOU is between Indian government and that European government. So these kinds of developments are very significant because this is giving an indication that this industry is going to be supported by the government in various ways, and that may itself act impetus for the high growth of that industry.
Absolutely.
So government regulation or government spending, say for example, the smart meter theme or the railway theme.
Railway thing.
So yeah, railway theme. So if somebody had identified that the government's focus is going to be on railways in the next 1 year, 2 year, 3 year, whatever, then he could have made a lot of money. I mean, just by identifying this fact that government is going to emphasize on railway,
Right.
then
Right.
will keep the promise, also that they are going to launch new railways, new trains, 300 new trains in 1 year per year. So if they are going to start 300 new trains, it means number of coaches, how many number of coaches will be manufactured, and every part that goes into a train coach is being manufactured by different companies. You know, the lighting component, the engine component, the wheels, the seats. So if we identify the companies related with that, the railway expenditure, then
Hmm.
this itself is a big advantage. If we can foresee that at the industry level, this industry is going to experience a high growth because of government expenditure. So in hindsight, it looks very easy, but I don't. I know it's very difficult to identify this. 1 year before, if I mean, it is very difficult to identify. Titagar vegans, Jupiter vegans, all these stocks have flight. and
But my
have
one
given
thing I would add,
profit.
maybe it's very difficult to predict what will happen at a policy or government level. But once it does happen, then we can take immediate action instead of sitting on the sideline and thinking ki, oh, ab to gaadi nikal gayi bahut aage, we have missed the bus. Like we need to sort of understand ki, okay, abhi the valuation is still not stretched. For example, investing in these railway stocks, even 6 months ago, when they had already run up quite a lot, would still have made a lot of money in the 6 months, right?
Yes,
So that is also, something that maybe comes from practice.
yes. Normally, yes, yes. Normally, we think that we have already missed the train, but sometimes the runway is slightly long,
Right,
and the company is going to report, extraordinary returns for the next few years. Some stories are, some stories end in months. Some stories are, multi-year stories. So for example, infrastructure related stocks in India, they are going through, the story of infrastructure in India is a multi-year story. This is not going to end, I don't think that, the infrastructure related stocks are going to experience, a down phase immediately in the same year, or I mean this will continue. A huge investment is going on in infrastructure.
hmm. So how much do you
And
think, I mean, yes, yes, please continue.
I mean that is evidence from their high order book. I
Right,
mean, report their order book, and that order book itself is suggesting that these companies are going to have good business in the next uh, a few years. I mean, their business for the next few years is already booked, and if they will further get orders, then it is icing on the cake.
right, right. But my one question regarding order book, sometimes order book can be misleading as well. Like if we just invest on the basis of order book, then a lot of times those orders are not executed, or those revenues are not converted to cash flow, or sometimes the order book projection is just too loud, like too optimistic, and it never really converts. So any thoughts on that specifically?
So we should not, we should be, we should not say, for example, we should not assume that we should look at their past margin. What was their past margin? For example, in the past few years, their margin was 10%. Then we should not assume that their future margin will be more than 10%. So if they are indicating that we will improve our margin also, then we can, on the conservative side, we can assume that they will not be able to, increase their margin. Increasing margin is very difficult. And similarly, if in the past their depreciation or interest cost, we should look at that at there also, because sometimes the growth is there, but that growth is profitless.
Hmm.
The top line is growing, but their bottom line is stagnant, or it is not increasing at the same rate at which the sales is increasing. So that is also a bad indication. So we can start with a positive mindset, but if some companies are not keeping their promise, then we should start becoming cautious. We should say, for example, if some company has given some guidance, and in the next quarter if they have reduced their guidance, then it means that, I mean, we have to digest this information also, that earlier they were giving a very high guidance, and now their guidance has also reduced. So this is a red signal. And for example, recently one company, MTAR Technologies,
Right.
so they have reported not a very good quarterly results, and at the same time they have downgraded their future guidance also. So
Hmm.
there is concept of opportunity cost. Opportunity cost. I mean, if we remain invested in such businesses, then we are foregoing the opportunity to earn much higher return in that is available in other businesses. So sometimes it is better to exit from such businesses. So my point is that we should take their guidance, their order book at the face value, and we should keep observing. And if we sense that something is wrong, the quarterly results are not in line with their earlier guidance, or the profits are not as per their guidance, then we should become cautious.
Right, right, right. Same with Avalon also. So Avalon, half of their revenue comes from the US and half from India. And earlier they were guiding 25% revenue growth for both India and US markets. So, but in the recent quarters, they downgraded the US growth rate from 25% to just 15%. And then the stock has fell heavily since then. It's, I think, the only EMS company that's not performing well for some reason. You were mentioning about permanent magnets, a very interesting stock. Can you talk a few
Uh,
minutes
uh,
about what you see there?
Actually, that is also one company related with electronics and
Yeah,
electronics manufacturing, and it is related with the smart meters also. Some component of some components which the that company manufactures goes into smart meters. Uh,
right.
I'm still, trying to understand that business. I don't have currently any live position in that stock. But when the whole industry is facing, good positive things, so I think, from that perspective, I was looking at that company because most of the EMS reports are ignoring that company. There are industry reports that cover Canis, Sierma, Avalon, but normally they don't cover, the permanent magnet. Maybe because it's a small company, or I don't know what is the reason.
Mm. I think it's probably because it's a small company. This is, I think a problem that all small caps and micro cap companies face. They don't get enough coverage. And I think if they do start getting coverage, so a lot of speculation that happens in small and micro caps, that can be dealt with. Like if research companies and brokerage houses, they start coming out with neutral stances on these small companies, so a lot of pumping and dumping that happens in these small companies, that can be avoided, but no one covers them.
Yes, that is one challenge of investing in micro stocks, and because there is no way to know about the business from annual report and from because normally they don't conduct con call itself. I mean, small micro stocks, only few of them conduct conference call. Otherwise, they
Hmm.
don't interact with investors. If you write an email, also they don't reply. Recently, I wrote an email to a micro stock company. I mean, it's a micro stock because 100 crore company. It's a 100 crore company. I wrote an email and I wanted an update regarding their promise at the time of IPO, that what happened to your promise of new 10 stores that you are going to open. Is there any progress on that front? But I didn't get any reply. So maybe lack of information is one thing
Hmm.
that is a kind of challenge.
I think that is why they didn't respond, because maybe there's no progress on that front, probably. If it were a positive news, then they might have responded.
Yes.
Sir, how do you look at certain companies which are not conventional? For example, in Indian context, we might say Zomato is one such company where there were no earnings, no profits for some time. Similarly, if we go back a few years and look at Amazon or Tesla or companies like that who have turned out to be very good investments, but at that time they were not making investment sense from the point of view of Benjamin Graham or uh, Warren Buffett. There was no margin of safety there, but they were excellent investment opportunities. So, how do we spot such companies, and how would you evaluate such investment opportunities?
Right now, the mindset that is required to invest in a company which is not earning currently, uh, I'm not able to understand that mindset, and I have not made any investment of that nature. If some company is making loss, I mean there is a lot of top line increase, but the net profit is not increasing, or they are still loss making, then we can only hope that in future, after 5 years, after 3 years, maybe after more than 5 years, they will start making money. But the kind of risk involved in such businesses is much high, and it may be this kind of investment may be suitable to those investors who have done very deep research on the type of product that the company is dealing in, and they are very sure that tomorrow or after some period of time the company will become industry leader, and it will command some pricing power also. There will be very less competition in the industry. If this can be ensured, then investment in such companies makes sense. Otherwise, in normal businesses, having normal product, if such a business is not making profit, then there is no sense in investing in such companies. The growth should be profitable.
Hmm.
Growth without profit does not attract me.
Right, right,
But
right, right.
what I'm saying is that if somebody has done very deep research.
I think we lost your connection. Okay, so we'll just wait for Tarak sir to join again. He'll join in a minute or two. Uh, if you guys have okay, his computer got shut down. No, no problem. Uh, so if there's any questions with regards to valuation or how we select companies or any stock particular questions, not recommendation advice, so you can just reach out to me directly via WhatsApp or my email, and I'll try to connect with you guys every Sunday through this YouTube channel. And thank you very much for joining. So that was very, very unexpected. Sir's computer, actually some issue happened with the computer and it got shut down. So that is why we might have to end this early. But inshallah, I'll try to bring him on again and we'll have a interesting discussion. Thank you very much. Assalamu alaikum.